All right, welcome all. This is our first sort of guest lecture in the this year's edition of Technology Entrepreneurship. We're doing it as a recording due to time differences. With us today we have Andrew Romans, who is going to be our venture capitalist guest lecturer. So Andrew is a general partner at Rubicon Venture Capital. He's also the CEO and general partner at 7BC Venture Capital. He's also written 3 books, 2 on venture capital and another on venture capital blockchain in that crossroads. So it's really a treat for us that Andrew has taken a little piece of his precious time to talk to us today, right? So we're gonna chat a little bit. Andrew's gonna share his wisdom, and hopefully it's gonna be a great conversation. So Andrew, welcome very much, and thank you for coming.
Thank you for having me. Good to be here.
So just to kick things off, I mean, how did you get into this, right? How did you end up doing what you're doing?
Sure. So I've always been an entrepreneur. So I started my own little startups in high school. From the time I was 14 years old. I had an assassination game going in the school, and then I had a little nightclub business running in high school where I finished in Paris, France. And then I had a t-shirt business throughout college. And when I graduated college, I got, just by accident, my first job was in technology and in the software Unix space. And then I moved into telecom, and I saw an opportunity to create a company. And I started my own company, which raised over $100 million of venture capital funding. And so when you go through all these venture capital funding rounds, you probably meet 20 to 60 VCs, venture capitalists, per funding round. And so we keep raising money for the same company at a bigger valuation. And so I met a lot of them, and I understood from my experience how it worked, and then eventually made the decision to start my own venture capital fund. And I don't think I'd be lying to myself if I took a job at a large company. I just don't think I would be happy doing that.
Mm-hmm. Well, I often, when I talk to my students, I try to emphasize even though it's a rather rough job being an entrepreneur, there's this ability to control your own fate that is quite attractive as an entrepreneur.
Yeah.
We've had a lecture on how to fund your venture. I'm obviously not a venture capitalist myself. As the saying goes, those who can't do, they teach, right? But so I would be interested if you, from your perspective, could spend a little time to sort of outline how you see sort of the stages of investments in a typical startup, if there ever is one. And some thoughts on that.
Sure. Well, I actually, having started a number of companies myself, and then been involved in now really hundreds of companies as an investor, I do think and talk about how to create something out of nothing, and how to create value in the very, very beginning. And in my first book, which you can get in English and Chinese as well, that book, I give very specifics, but I'll outline a few here. One is what I did with my company, the Global Exchange, was I started recruiting advisors to be advisors to the business, where I was giving them a little bit of equity without raising money. And these were very big, important people in the industry. So I had the former chief financial officer of AT&T, which was the largest telecom operator outside of Japan in the world at the time. And so you can recruit a team of advisors. That's good. And sometimes I say even pitch to lawyers before pitching to VCs. If you find the lawyers that all they do is venture capital financings and M&A work, they've got a really good network, and they can even introduce you to investors that are suitable for each stage that you're at. And I did something which I think can be replicated is I recruited 5 people to be, like, I call them my lieutenants, to be the head of each different business area for my startup. And these guys were older than me. They had kids. They couldn't afford to just join a startup with no funding. So I said, contingent upon $5 million of funding, we signed employment contracts that they would work for my startup on a salary of $150,000 each, which was a lot of money in the mid 1990s. And so I actually, by the time I went to VCs, I managed to have, it would be similar to going to Huawei or ZTE in China. I had Lucent. Lucent Technologies offered me $25 million of vendor financing. So I could buy telecom switches up to, it's like having a credit card with a credit limit to buy stuff from this big tech, like Huawei type company for up to $25 million, but contingent upon closing a minimum of $5 million cash funding from a VC. So I had a full team. I had the biggest telecom partner to help build this network, and all I needed was $5 million of funding. And I had a very strong senior industry advisors built in. So before raising any money, I really kind of put together the team that was needed, you know, with a clear vision of the market we were going after and some unique technology we were going to build to give us a huge advantage over, you know, competitors, and the way things would be done with us much better than the way it was being done without, you know, our startup. But Erik, you asked another question too, which is for your students to understand, there is a continuum of investors that invest very early stage, almost when it's still an idea with one person and there's no company yet, all the way up to investing in, I would say, pre-seed. Some people say friends and family, but there's more institutional pre-seed money now than ever before. There's accelerators that often provide a little bit of funding and some structure that brings you out to a demo day where you're pitching to a room full of physical investors and virtual investors online. There's investors that'll invest while you're in the accelerator, hoping to see a big jump, getting into the good ones. They see a lift within, you know, 4 to 6 weeks of their investment going up, that they invest at a lower valuation than the demo day round. You invest, there's the demo day financing, and then you get into kind of seed extension or pre-Series A funding rounds. And I think in the US, you typically see the startups have $100,000 of monthly reoccurring revenue by the time they're doing a late stage seed round. And so that's really over $1 million of reoccurring revenue. And then when you have a Series A, the size of a Series A these days is around $10 million. So in order to value the company where you're only taking 20 or 30% and putting in a $10 million check, they tend to want to see more revenue to justify that. So we're typically seeing something like $500,000 of monthly reoccurring revenue. So at least 6 million annual revenue run rate. And then there's Series B, Series C, Series D, up to the company could IPO, but they're still private, like Uber raising at a huge private valuation. And you have people buying and selling already. So even though there's no M&A acquisition of the startup or listing on a stock exchange like Shanghai Stock Exchange or the New York Stock Exchange, you have early investors and employees are selling some of their position to other investors buying at a higher valuation. So I just wanted to give you, there's sort of a full picture of investors at every stage.
All right, that sounds great. Thank you. So, you know, as this is a course, right? The students are, well, students, right? So I have had students in the past who've already started companies. As far as I understand, this year, maybe not. Though, you know, the normal in-break discussions we have is not possible this year as we do online teaching, right? So I may have missed some. But let's assume that most of our students are sometime in the hopefully near future first-time entrepreneurs. And things move well for them, they will at some point start meeting you guys or your colleagues, right? And of course, your whole business is to invest in good startups. So you're really looking for them. But as a first-time entrepreneur, it may feel rather daunting to convince the movers and shakers of the venture capital industry to fund, particularly just me, right? So what sort of advice in general would you have to an entrepreneur trying to raise money from a venture capital? What's the secret sauce to actually get funded, so to speak?
Well, I think there's, in my experiences in China, and Erik, you and I have had the opportunity to meet in person in China before. There's a lot more venture capital funding in China than there was a couple years ago. I think things have slowed down a little bit, but I would argue there's almost too much money chasing too few good deals in China. And it may be easier to get funded with the same company at the same stage in China than it is outside. Now, there's going to be a lot of variance depending if you're in Chengdu or Shenzhen or Yangzhou or Hangzhou or wherever you are. Just like there's more, about 70% of all the venture capital funding in the United States is in Silicon Valley. And, more than 70% of the unicorns or billion-dollar valuation companies are in Silicon Valley. And all top 5 companies by market capitalization on the US stock market are in California or Washington State. It's just Microsoft and Amazon are the only 2 up there. So it's all West Coast now. You may see some Silicon Valley popping up in different parts of China. But a short answer to your question, Erik, is VCs tend to look at 3 core things. If they don't see these things, they typically do not invest. They need to see a team that they believe in. And the team needs to not only be a strong team in general, but the correct team for that mission. So if you're attacking the print industry, if the team has experience in the old print industry and they're now trying to digitize it or put it online and automate it with AI or something, is that the right team for that job? So team is probably the most important thing. A second thing is that the market needs to be there. Now, if you're in China, you've got the world's biggest or maybe the second largest market in the world. So that's a big market. That's very important. If you're addressing a small topic in a big market, the VC will say, well, how big can this be? If only less than 1% of people in China would ever do this, that's not a big enough market. So identify a large market, addressable market. And if the market you're addressing is too big on day one, you might go bankrupt and get killed by bigger players. Sometimes it's good to have a strategy to address a well-defined market that you could become a monopoly in, and then use that to grow into a larger market. So market is extremely important. Technology for us is something we must see too. And most technology-driven VCs want to see that you either have unique technology or a clear period of 6 months or more of a lead ahead of your competitors, and that you can maintain a head start and be ahead of your competitors when it comes to technology. And you could talk more about little minutiae of scaling and things, but I would say team, market, and technology are 3 core areas that you want to have a very strong story on those 3 things.
So yeah, that aligns with my thinking. Some people would argue, and I've had a VC guest lecture before whose core argument was, if you can avoid us, do so. What would you say about that? And If
What
you
did they
can
say?
avoid us, do so.
Oh, okay. Yeah. I mean,
Uh,
go ahead.
Basically, the question is what when you what dangers should you be aware of when you start bringing in investments from venture capitalists
Well,
as
first
an
of all,
entrepreneur?
VCs have different strategies. If you're investing very early stage and you have a large portfolio, you're going to have a higher percentage of your startups go bankrupt. If you're investing later stage where they're already profitable or very high growth, it's less likely they'll go bankrupt. And as an investor, your money possibly is the first money to get out as opposed to the last money to get out. So there's different
Mm.
there's different perspectives. Not every business is suitable for venture capital funding. So a lot of services businesses that all they do is they make websites and there's no technology that's unique and it's just a services business, or it's a headhunting business. It's like a consulting type business. And so not everyone is suitable for venture capital. And for VCs that do have a death rate, imagine that you've got $150 million fund and 50 million of your money is going to go bankrupt. So it'll go into startups and it never comes back. Another 50 million that you invest, you get your money back 1x. So you're now down 50%. The other third has to do so well that it moves the needle on all the 150 to at least a 40% IRR. So, and you're hoping to make a 5 or 6x return on the 150. So that means that you need to show a VC that if this works and it goes well, it will not only be a good investment by itself, but it'll make up for the dead 50 million and the flat 50 million to still put you as outperforming really all other asset classes. Venture capital typically outperforms every other asset class. If there was, if we could make it bigger, we would. It's got a natural how much money is in the system chasing good deals, like ecosystem balance of how many tigers can survive in that African country. Maybe that's a bad metaphor, but in general, when someone says avoid us if you can, for my early businesses that did not have VCs, I didn't have to give up ownership. So imagine you build a company and you sell it for $5 million and you get 100% of the exit consideration. So you literally got on one day $5 million cash. You have to pay tax, but it's all yours. An alternative is that you went through 5 or 6 VC funding rounds where you're on average selling 20 to 30% of the equity. So you're getting diluted. You own less and less and less. And if you raised, say, $5 million of venture capital funding, typically the VC gets their money out first, and then it's pari passu. Everyone gets paid their ownership percentage. So if you own 10% of the company and it's sold for $5 million, then you're looking at maybe making only 500K. But if the first 5 million pays the VC, that's a liquidation stack. They get their money out first as preferred shareholders. You're maybe not making so much money. So for some people, they would say, I would rather own my business and not be obligated to pay the VC first before I get my percentage. On the other hand, with funding, you can often use that money to develop a product that you didn't have the cash to develop when you were just purely running a profitable business that was probably like a consulting business. So some companies are more suitable to venture capital than others. And in some cases, the entrepreneur might be smart to maybe not take capital and own everything at exit, or don't raise that much capital. I know a guy, Raul Vora, he founded Reportive. He only raised a small amount of money, like he raised something like 1.5 million or 2 million, and then he sold the company to LinkedIn. So LinkedIn bought it for $15 million, and he only had to pay this 2 million back. and he owned something like 70% of the company to get most of that exit consideration. Now he founded Superhuman. I've invested in it at different valuations, and the valuation of his business now is already over $500 million in value. His percentage ownership is quite small, but his value on paper is now far bigger than the 15 million. Now, I think for him, it was good that early in his life, I mean, literally in his mid 20s, he sold his business. My kids have enjoyed his Lamborghini that he's got. So he's living life well. And now he can afford to build a big company that could maybe take more than 10 years to get to an exit.
So yeah, and so basically, you know, you need to for many reasons, but this is yet another reason at an early stage of your venture, sort of have a sense of where you want to end up with this personally, right? I mean, to make this decision. Would you say so?
Absolutely. And I was trying to convey a little bit of that knowledge early when I was saying that you have investors that invest very early, or they invest along the entire continuum, or they only invest at this stage or that stage. And you do have a secondary market. So for example, we invested into a company called Daily Harvest at a pretty early stage. And then Lightspeed, which is a very large fund, that their fund is so large that for them to make a $1 million investment and make a 1,000x return doesn't do a lot to take a bite out of this $1.2 billion fund, which they want to deploy over 2 or 3 years. So they're looking to write much larger checks. The company only wanted to raise $15 million, 1-5, and we ended up agreeing on a $47 million investment from Lightspeed into Daily Harvest, of which only 15 million was what we would call a primary investment. The remaining money was all secondary. So you had founders and early investors, friends and family, really early stage investors that said, hey, I'm going to sell 20% or 10% of my shareholding at this big valuation when I was an early employee. And now this enables me to buy a house or send my kids to an expensive American university. That at that point in their life, it made sense. We discussed, did we want to sell any of our position into it? And we decided not to sell anything. But we also chose not to invest at that big valuation. So we liked it at 30 million, not as much at 300 million, valuation. So we were happy to not sell, but not put more money at that point. Many others were selling, and new investors were buying shares on the secondary market. So that means that if you're thinking, do I sell my company now so I can be set up for my next one, or do I not sell my company but just sell 10% of my stock to the newest investor? People have more options now than they did 20 years ago.
Yeah, that's true. So I now when we've discussed that, I had a question myself that I've actually never considered much, but I guess you would be a good place to answer it. I mean, over the life cycle of a VC fund, right? Because as you said a couple of questions ago, after a while, I mean, you hopefully about 1/3 or so of them will do well to sort of, make sure that you overall get a good return of the fund, right? But over the lifetime, then because I presume at some point, maybe halfway, you will start to get a sense to who the winners are and who, where's the slack. How do you interface with the ones who you're getting more and more convinced it's not really gonna cut it in the end, right? Do you sort of let them go, or what do you do with those guys?
So every VC is unique. Every person and human is unique. So they're not all the same, but every VC should have a very well-defined portfolio construction. Okay. And so I'll talk about what our portfolio constructions have been and what they are, and then I'll come to how do you communicate to the entrepreneur that you don't want to put more money into. But a common strategy that we had at Rubicon was we're going to take 30%, 30% of our cash, that's the dry powder for funding companies, and we're going to make sure that we spread it somewhat equally across a minimum of 20 different companies. So 15 is a magic number. If I see a VC investing into fewer than 15 companies in its early stage, I think they're actually foolish and stupid. They're playing lotto, which my father calls tax on the dumb, buying a lotto ticket. So you really want to achieve a diversification of minimum 15. We kind of like 20 to 25. So 30% of the money is now so diversified, if 10 of them went bankrupt, you should still be fine. 4 of them would easily return all the money. 1 of them might return the whole fund twice, like a Superhuman or a Daily Harvest. And even if you get half your money back on one and the fund is already profitable, that's great to be getting that money back, even if you're already profitable. So you can see a partial loss where you lost half your money. If the fund is profitable, that's a wonderful day. Like my wife will be happy to see we just got 20% of that money, that came back to us. Now, 70% of the money we're using for follow-on investing into the existing portfolio. And so this is where we're putting the 70% of the money into our winners, not the losers. And that raises the question you asked: how do you communicate to your non-performing company that we're not going to provide you any cash funding at a time when you need it more than ever? But to finish up on portfolio construction, 30% very safe, diversified, 70%. I like to joke about Gordon Gekko with insider trading information, that Gordon Gekko in the movie Wall Street goes to prison for buying and selling stocks on the stock exchange that are liquid based on insider trading information. So he's got, was it Charlie Sheen running around on a motorcycle finding out about Blue Star, their sales deals, and then trading. And then the very next day, when the news hits the press, they sell their entire position. And he goes to prison. Nobody wants to go to prison in China, and nobody wants to go to prison in the United States. So with us, I like to say, we invested in these 20 companies. We have the financial information on all of them. We're trying to help them. So we're like a continuous big data machine, collecting information and deciding which one do we put more money into. So Daily Harvest does really well. We invested in them 3 times before we stopped investing. Other companies are failing to get customers. They're failing to get new investors in, and they're running out of money. And we're saying, I'm not going to put more money into it. Now, we only did 30% to achieve the diversification, and 70% is almost, it's never guaranteed, but it's going into the real winners. So it actually makes the risky venture capital asset class safer than the stock market, safer than the bond market in a quantitative easing pandemic environment, safer than real estate. So we believe that this portfolio construction is a high reward, low risk asset class. So instead of saying it's high reward, high risk, we're saying it's high reward, low risk, which makes it a beautiful asset class. Now, to finally answer your question, if you can even remember it after me talking for so long, the truth is, entrepreneurs, a lot of them will say, if you don't fund me when I needed it, I will hate you forever. And I will say, Andrew Romans is a vulture capitalist, money-loving Satan. He's the devil because he didn't fund me when I was sinking like a sinking Titanic. And I have to live with that some people will say that about you. Most entrepreneurs understand our portfolio construction, and they know that. And we say to them, I'm going to introduce you to everyone I can and try and get them to invest into your company. But our fund doesn't have the model of invest in a company. When things go really, really bad, we put more money into it. Now, sometimes you can. Sometimes you can say, things are not going well. I believe if we fund the company with some more money, we would actually get a 3x liquidation preference, and we could still sell the company for less than the total funding it's gotten, and we'll get our bridge round back 3x, and we'll have a better outcome for everybody. So even in a bad situation, we can position ourselves to be very supportive of the company. And let's say that the company raised $10 million and we literally put in $1 million. We have a 3x liquidation preference. The company sells for $3.5 million. We get a 3x on the 3, and we basically wiped out on the earlier money. So, you know, every situation's a little different, but some people call it a negative signal if existing investors are not willing to put more money into the company. And to some extent, that's true. And to some extent, I think that, you know, Tencent and Alibaba and Baidu Ventures, those are big boys and big girls. They can make their own decision, even if 7BC decided not to write a follow-on investment check. And I'll tell them, we're right now writing bigger checks ourselves into our companies that have over 100 million in revenue. This company just doesn't fit that model. We were happy to be in it early, and we're happy to see you join us in supporting the company. So we'll say everything we can to say positive things, but we'll be very disciplined on adhering and sticking to our portfolio construction to basically take the risk out of the asset class for our limited partner investors in our fund.
Yeah, thanks. And to our students, I want to emphasize that this is the reason I've been talking about in a previous lecture about, you know, how a VC functions and how they operate, and why Andrew is here to talk to you too, right? So that when you look for investments from a VC, you know what motivates them and why they do what they do, right? So you know who you're dealing with. So you're not in for nasty surprises, because you understand what they are doing. They are doing business as well. You mentioned Tencent, Alibaba just now, and that makes me think of because one of the books you wrote is about corporate venture capital, and which well, to an untrained eye, money is money, right? But not necessarily so, right? So how would you how would you describe any differences between what we call normal venture capital and corporate venture capital, especially from the perspective of, you know, the investee, the companies that are trying to raise the money?
I think it's an extremely complicated topic, and the more I learn about it, the more complex it becomes for me. I have the personal experience of being a founder of a company that raised a lot of money from Lucent Technologies as a corporate venture capital, you know, group. So they're looking for strategic returns more than just a financial return. They typically want to see both. Actually, I have a background in telecom, and after the .com crash and the end of the golden days of telecom, the only way to get vendor financing was to get the China Development Bank to lend money to ZTE or Huawei, and then Huawei would let you build your network for free, and then after you get customers, you pay Huawei, who pays down the China Development Bank. And so I've done a lot of business with Huawei over the years, and Huawei asked me to advise them on the formation of their corporate venture capital unit. And I said, okay, I know basically all the big CVCs in the world. Why don't I interview the top 20, and I'll ask them how they do everything and what they would do differently. And I'll put that together as a report for Huawei. And I'll also keep interviewing another 100. I think I had over 200 interviews in the end with CVCs, which for me is just my normal job. I had breakfast, lunch, coffee, tea with a CVC, looking at their deals, looking at my deals, and interviewing them for the book. And so I wrote a book, Masters of Corporate Venture Capital, that has the original 20 Huawei interviews and then like another 160. And it's complicated. For example, I introduced Node Prime to Albert Kim at Ericsson Venture Partners from your native Sweden. And Ericsson's a good company. They're number one in a declining market. How many more mobile phone networks do we need in Hangzhou? And so they're in a declining market. So they're using corporate venture capital as a weapon to acquire companies in the data center business. And I had led the investment into this data center company, Node Prime. So I introduced them to Albert over at Ericsson Venture Partners, the CVC, and they invest in the company at a much bigger valuation, good for everybody. And then they ended up becoming the biggest customer of the company. And then they decided we need to acquire this business. So now they have a little bit of a conflict of interest. Ericsson wants to buy the company for a low price, and the company and their VCs want to sell the company for a high price. So think about that, Erik. These guys come in as a CVC and invest in the company, and then now their parent company wants to buy them. Do they want to sell it for $1 billion, or do they want to sell it for $100 million? They wanted to buy it for the lowest price possible, and they have a board seat voting, let's take the low offer from Ericsson, where the rest of us are saying, no, make them pay $1 billion to buy our company. So that's just a small illustration of the conflicts of interests that you can experience when dealing with corporate VCs. And, you know, their investment committee might include the CFO of a $100 billion Huawei. And literally that guy needs to read a memo to make a follow-on investment of $700,000, you know, while he's out buying $1 billion power plant or something. So corporate VCs are notorious for being slow. Sometimes they need to have the head of a business unit say, I'm not going to develop it at home and we're going to externally develop this. There's a lot of things happening there that will make them slower and with more conflicts of interest than a financial VC like mine. But they're promising, oh, we could become your customer, or we could buy you. We could do distribution for you around the world, and your revenues will go up, 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 and up. So we're seeing corporate venture capitalists are in typically, depending on the country, between 20% and 40% of every VC financing. In Japan, it's 80%. So most venture capital in Japan is corporate venture capital, and they don't seem to have native independent ones. So to ignore it is, if you're an entrepreneur and you plan on raising venture capital funding, I don't make a lot of money on the book, but I'm telling you, it's required reading. You should understand it before it's too late, that you've made an irreversible decision and you can't go back on it.
Sorry if I appear distracted here.
No problem. Work from home. Everybody's used to it. It doesn't matter.
My 3-year-old is getting antsy, so he keeps walking in here. Yeah, that makes a lot of sense. Anyway, so one reason also, if we're comparing VC and VC, right, that's interesting to me, I think, because the reason we know each other is because we met in China. Doing more venture capital investments in China. So how would you characterize VC in China? Is there, in your opinion, a large difference between VC in China and the US, or how would you characterize the difference between VC in several regions of the world? I know you're quite involved in the Nordic countries in Europe as well, but maybe especially China versus other places.
Well, I think in China, and I should be very diplomatic in what I say, I think in China, things tend to happen faster and better when you are collaborating with the government. And to have government relationships is incredibly important. And a lot of Chinese VC funds have a certain percentage of their capital. So when you're a VC, you're not much of a venture capitalist without the capital. So you've got to raise money from somebody. And in China, you tend to see these municipal fund of funds that will commit some cash to the fund. And then you have these fund of funds that are large pools of money that can put money in as a matching basis to the government money. And the government typically will not invest in a Chinese fund without matching money. Very similar in Europe. And you tend to have state-owned enterprises, SOEs, are investing as well. So you end up with these corporate SOEs. You get these sometimes listed companies that are on the stock exchange, and you've got these specific fund of funds that their business is to, it's cheaper to put the money in the fund of funds and have them do the work of evaluating a fund manager, and even being able to write a bigger check by aggregating money to then invest, meeting the minimum check size for some VC fund. So you tend to have that. And I think that relationships in China are as important as they are anywhere, and even more important. If someone has the relationship to get the money, that was even more important than having the skill set or experience to be a venture capitalist. So you tend to see, you have first-time entrepreneurs. I've met a lot of people that had no experience that would really get them a job in venture capital, but they had the relationships to get the money, and then they've learned from that experience. So it's a bit of a younger industry from what I've seen, in China. And I would say that you have a supply and demand. What's the supply of startups seeking to raise money? And what's the demand from investors to invest in those? And there's a strike price of what's the supply and demand for gold. And that's going to set the strike price. I think that compared to Europe or the United States and Nordics, in Nordics, there's a high volume of high quality startups, and there's a relatively small amount of cash from investors. So Northzone, Creandum, these guys have near monopoly to invest in the companies at very investor-friendly terms. Whereas in China, that same startup would have a much higher demand from relatively new fund managers. And I think that the valuations end up being higher, which is a positive for the entrepreneur. But it can be dangerous as well. On valuations, an experienced VC in Silicon Valley, like going back to Node Prime, Ericsson gave them $5 million of revenue in the fourth quarter of 2017, I think it was. And it was up from almost zero. So they had a couple $100,000 from some POC trials. All of a sudden, they're on a $20 million revenue run rate out of nowhere. In Europe, somebody would try to raise money at the biggest valuation possible. So they probably would have raised money on a $200 million valuation as a 10x multiple of their 20x annual revenue run rate. That's what I expect to see in Europe. In the United States, we raised 10 million on a pre of 40 because that's a post money of 50 million. And if we sold it for 4x, that would satisfy investors, which means we could sell the company for 200 million. And there's a lot of buyers that could buy Node Prime for 200 million. And we could run a very healthy investment banking process and make a quick 4x. In Europe, now they've got a 200 million post. They have to sell the company for like 800 million to satisfy investors. And there's only a small group of companies ready to do that. And what happens when they say no? So, there's a different evolution of levels of sophistication at play. It seems counterintuitive to raise 10 on 40 when you could raise 50 on 200. But we thought we were pretty smart doing 10 on 40. And I just think that's what 20 years of experience, kind of looks like, as opposed to 4 years of experience.
Yeah, that makes sense. It's interesting you mentioned that, in the Nordics, the investor density that a company will meet is lower, right? And I have a friend in Sweden who's he started a long range of companies, some of which did pretty well. And we were discussing just this at one point, how to choose your VC, right? And he said, well, look, Erik, you have to bear in mind that it's all good and well to say that you should evaluate your options when you look at VC companies and pick the one that suits you best. But sometimes you only have the one
Yes.
one investors, right? So, but
Yeah.
if you then, as you say, there may be more suitors to a company in China. If you are in the fortunate position of having discussions with several venture investors, what to think about, right, when choosing your venture capitalist, if you're in that fortunate position, right? What are the signs of a good one, and what are the warning signs of a not so good one?
Well, so I think that the key things I advise the startup to consider are: one, what is the reputation of the fund? So is this, Goldman Sachs, JP Morgan, or is it, the boiler room JPM Marlin from Long Island, making fun of the movie Boiler Room. So is it like Tsinghua University or Harvard, or is it a small fund nobody knows? And to get into Harvard or Stanford or Wharton or Tsinghua, that's good, right? So you should consider the reputation of the fund, but you should also really consider the relationship with the partner who's leading the fund. If you get along with me and you have good chemistry with me, then it's probably going to go well. If you've already decided that you think my comments were incredibly arrogant and I'm just a horrible guy, then if you hate me, I'm probably going to feel it. And the relationship is a bit of a marriage, might not end well. So you should make sure you've got good chemistry with a partner. And ideally, the partner understands your startup and understands your sector, and you think that they can add value and you're going to get along. So the reputation of the fund is important, but you really need to have good chemistry and relationship with the individual people you're dealing with, at the venture fund. And then a third thing is you should consider the economics. Entrepreneurs that are first-time entrepreneurs, they tend to only focus on the valuation and their dilution, which is a more experienced entrepreneur might be figuring out, so if I do this now, what happens next? So if you raise money at a $200 million valuation because you've got one customer that brought in $5 million in the last 3 months of revenue, what if Ericsson backs away and your revenues go down to zero? Now you went from a 200 million funding round to a lower valuation. That's where CEOs get fired and wiped out and people get hurt. So, it's important to be sophisticated on your understanding of the terms of the deal. So I'd say reputation of the fund, chemistry with a partner, and economics and terms. And the economics and terms should be more sophisticated than the single thing that baby entrepreneur understands, which is crying about valuation the second they come out of their mother's womb. As they get older and more experienced, they're going to say, well, at least I've got control of my board of directors. Governance is incredibly important right next to valuation. What's the employee stock option plan? How much capital do we have reserved for future funding rounds? Or how much equity do we have to attract and retain talent, as well as go through future funding rounds? And let's price it now for success on the next funding round. Once you're in the venture capital ecosystem, you tend to raise capital every kind of 9 to 24 months on the long end. And you kind of want to set the pricing now to make sure you're successful on the next one.
That makes sense. We maybe we do a couple more questions and then start sort of rounding off. But I was thinking, because this is maybe not so VC related, but because you've done this journey, right? You started a company, you built it, it did well, you did your exit, and you also worked with a rather long list of startups as an investor. Right? How would you advise, say that, because your job as the CEO of a startup with that consists of 3 co-founders, right, is rather different than the job of a CEO that is taking his company public, right? What do you need to do to grow with the company to remain the CEO throughout that journey, or should you even attempt to, right? Should you realize I'm a startup CEO, I should get off at some point. But if you want to,
so I think
if you want to do that journey, what should you do?
So the question is, a lot of first-time founders are concerned about being pushed to the side and a new CEO comes in. How do you protect yourself and remain CEO? Is that your question, Erik?
Yeah, well, I mean, it's one thing to protect yourself, right? But that's very defensive, right? I mean, if you want to remain a good CEO as you transition from a garage startup into an actual company up to a rather big one, right? What do you need to do to be able to grow with the company to remain a good CEO?
Right. Well, I tend to like it when the founding CEO remains the CEO all the way, and that they evolve as an evolutionary organism themselves. So the skill set of having the grit of bootstrapping and getting the first customers, you're the head of sales, you're the head of product, you're a fundraising team, you're doing everything. I think it's important for founders to try to recognize what are we missing on our skill set? What are the missing bits that need filling in? Where are we strong? Where are we weak? And then make an effort to fill in the missing bits with internal resources and external resources. For example, if you're weak on fundraising and you bring me in as your VC, I kind of know everybody. And so I can introduce you to the investors that I think are suitable for this geography, this sector, this stage, to fund you on your next round. If you're weak on sales, a lot of CEOs fail to recruit a head of sales and even understand how to speak the language of compensation, bonuses, engineers are very different animals than these shark sales guys that want a bigger car and a bigger house. They're so different. So, I often bring in this one guy I know who is an extremely successful entrepreneur who's been a VC since 2000, Tim Galleri. And if Tim invests, he can fill in the missing bit of structuring the sales organization and scaling to the next level. So we do a big funding round. Tim comes in and really teaches the guy the sales force. I do it too, but I'm not as good as Tim. And I don't have the level of experience of building sales teams of 500 people. My biggest sales team was 55 people, whereas Tim has taken it much bigger than me. And so I think it's important to surround yourself with people that are smarter than you, surround yourself with people that can do the things you're not good at, and that's more likely you will survive as the CEO. And just like in a marriage, a lot of communication. Communicate with everybody constantly within your organization, and constantly communicate with your board of directors externally, and constantly communicate with new investors, buyers that will M&A buy you, bankers that'll take you public or sell you. There's a lot of people to talk to and only so many hours for sleep and exercise, and taking a vacation, unless you're Swedish. No, just kidding. But so I think that take a view of your company is constantly changing as it goes on a roller coaster ride, hopefully up and to the right on the continuum. Recruit people that do the stuff that you're not good at. Offload sales to somebody else, but keep communicating. Offload these things. And another one is pay very careful attention to the construction of your board of directors. So at the end of the day, the board can vote to replace the CEO. And if you've got the votes, then you're winning. So certain politicians have a lockdown on 30% of the population. And with that, they've got absolute power. So sometimes a subset of the board is what is required to lead without anyone replacing you. And so I would be very careful of who you bring in onto the board of directors, and make sure that they think you're the smartest guy who they should follow rather than replace you if you're worried about being replaced. And it's actually a big topic of when is it right to step down. I know a guy who was a big VC who then became entrepreneur. So people go back and forth in both directions. And he put his founder shares on a 4-year vesting schedule, which is kind of best practice. And then when he hit 4 years of fully vesting, he said, why should I stay here? Because I have all the equity I'll ever get in this deal. And he's already a pretty rich guy. He replaced himself with another CEO, someone internally, and then he left. And then that CEO went out and did a management buyout and then pushed him down to near zero. And when the company was sold, it was sold for less than the money invested, and he got nothing. So leaving and replacing yourself on purpose is a delicate, complicated endeavor in itself.
One second.
Sure.
Sorry, my son is still here. I'm thinking about two questions more. One is, our discussion now is really about the relation between the VC and the entrepreneur, but you're interfacing in another direction too, right? You have investors, limited partners who in turn put money into your funds, right? So how's your daily life, raising money from these guys, and how do you work with your limited partners, just to sort of give a more fuller picture of
the full picture
the life of a VC?
That's right. So my role is the general partner, or GP, and then we have limited partners, or LPs, that invest capital into the fund. The GP also I invest my personal savings into the fund as well. So I'm a GP and an LP in every fund that we operate. Typically, VCs get their money from a mix of investors, and for some, it's all institutional, and for some, it's even all kind of retail type investors. So we raise capital from institutional investors like fund of funds, endowments, pension funds, insurance companies, and then we also raise money from large corporations. So part of my working on and research on the Masters of Corporate Venture Capital book have been very productive for me, because I can talk to a large corporation that's looking to get, like Ericsson, out of their number one in a declining business into a growing business like the data centers. So we can be very sensitive to understanding their financial return desires and their strategic return desires. I think the whole world is going digital. Corona is an accelerant of that. And so governments, large corporations know they have to automate workflows, accelerate, use of things like Zoom and, video conferencing. And VCs tend to back the companies that are making that happen faster, and to automate human tasks with software. If you have a person counting something by hand, they're not going to do as well as the one that's got a spreadsheet like Microsoft Excel. Trying to do a private equity deal without a computer is insane. It's like trying to do it on a calculator as opposed to a spreadsheet. Well, we basically think all business right now, and government and education and healthcare, is being done like in caveman methods, where the human literally does everything. And we think it's a great opportunity to begin to automate these workflows and bring technology. And so one human can do a million things in a second, rather than over a long period of time. So we find it valuable to have large corporations and businesses as investors in our funds. And we also like to have the individuals. So it's a small percentage of our money, but it's a big value add to us as a firm that we've got. No, I love it. By the way, that BBC thing where he's pushing the kid out, like, taught everybody, just put that cat on your lap or your kid on the lap during these COVID things.
Yeah.
It'll probably stay with us forever. But, what will stay with us forever, even from COVID, is, the need for companies to have a digital transformation program, but in a real way. And so we find it valuable to have high net worth individuals as investors in our fund, have large corporations as strategic investors in our fund, and we're able to create partnerships between the startups and these LPs. At the end of the day, we want to add value to the startup beyond our cash check. And so selection of these LPs is a true differentiator. I'll close in saying that a lot of our investors come from different places like Singapore, Malaysia, Indonesia, Switzerland, the Arabic Middle East. And so for us, we're able to help our companies do business in China or do business in Southeast Asia, as opposed to just being 5 guys in Palo Alto, California that don't have a passport. So it's important to get, kind of international set of LPs from our perspective.
So I unmute myself first, and thanks, that makes a lot of sense. So maybe we round off by asking, what's your sort of general advice on the one hand to students why should they consider once graduating not seeking employment, but rather trying to create their own employment, so to speak, right?
Yeah.
As an entrepreneur, and also general advice to budding entrepreneurs, right? What to think of and what to look out for.
Yeah, well, I think the culture is changing. In Japan, top graduate from University of Tokyo still has their first choice is getting a job at the government or a large corporation or big consulting company. When we had the .com crash in 2000, 2001, MBA students were jokingly saying, you know what B2B means? It doesn't mean business to business. It means back to banking. And B2C doesn't mean business to consumer. It means back to consulting. And so even in an economic downturn, there might be less entrepreneurship, but an economic downturn could have people fired and furloughed, and they have a little check to live on, and they're forced to develop their own startup if their job search is not going well. I think that in the United States, we've hit like a peak level of culture that everybody wants to be Mark Zuckerberg and be worth $100 billion and have it happen overnight and not work your way up the Japanese ladder to peak at 500,000 annual income. So I think that children today are very materialistic, and they want to drive a Ferrari, and they want to be rich, and they want an SUV in private schools. And a lot of them are chasing entrepreneurship as a way of doing that. As far as I'm concerned, it's good to have, the percentage of patents and innovation that used to be coming out of all corporates. So like 80% of all patents were coming out of, Munich, large corporations in Germany compared to startups. Now we're seeing a lot more innovation happen with startups, and that's part of the interplay with corporates. If American top graduate from Stanford wants to be the next Mark Zuckerberg, what's your strategy to access that talent pool? And so I think it's corporate venture capital and it's M&A. And it's a real shift. It wasn't that long ago that top graduate wanted to work at your big corporate. Now they're going into startups. I think it's probably smart to join a startup that's already funded as your first job out of college rather than start your own. I'm not against starting your own, but starting your own when you have no business experience, sounds like a disaster, a recipe for disaster, but it might make sense to join a high growth startup, experience from osmosis a whole lot of learning there, and then with a few team members, go and start a startup and maybe get a little bit of funding from the CEO. And that CEO can introduce you to VCs and other people to help your company. If you end up getting startup experience and it's in real technology, you're opening good career paths. You could go become a Goldman Sachs investment banker because you understand startups, VC, and technology. You could get a job as a VC and you've got some startup experience. Or you could stay with entrepreneurship and be successful there. When you join an accelerator these days, if there's, 50 companies or 100 companies in that Y Combinator accelerator, yours might fail, but you get recruited to join the one that's really winning. And being an early employee of Google or Baidu or Tencent or Facebook, that could be a very good outcome for you. You might become very rich and just use that money to be an investor. So I think being an entrepreneur in a tech startup has lots of good career paths for you. What's probably not good is when you join a startup or start one and it keeps living as a walking dead and never goes up. And you wake up 15 years later that you're still in a bad business. So I think it's important to lift your head up and look around and say, should I stay here or should I make a move?
Yeah, be quick to pull off the Band-Aid if necessary. That's very good advice. I think that join a startup first of all, learn the ropes a little bit, and sort of get immersed in the community to find the good opportunities, the right people to work with.
Yeah. Also, sometimes it's good to come right out of school, and if you can get a job at Google or Baidu or one of these big famous companies, Tencent, and work on something really interesting, that can be an incredible pedigree. Having Google and Facebook on your resume, on your CV, can be more important than having gone to Tsinghua, Harvard University. So heading into the large corporate in tech can be good. I sometimes say, if you get a job working for the US Post Office, since email, it's going down. They're shutting post office. So even if you're really good and you're the best employee at the post office, if they keep getting smaller, it's hard to go up. If you join a company like Google that's just making so much money, it's a monopoly. Just by not making mistakes, you might go up just because you're there. So it's not a bad thing. Yeah, it's not a bad thing to go into one of these. Amazon is probably going to keep growing. So if you get Amazon right away, a lot of startups I've seen say, we were doing the reviews on Amazon, and now we're taking the same people who did the reviews for Amazon are offering reviews for any website. So that's an actual thing. You work at a large corporation that has enough power to do something internally, and you create it as a product service offering for any website, or to anybody. So you see a lot of tech transfer coming out of large corporates. So that can be, I think it's good if you're young and graduating from college or university, explore all of these opportunities. Take some job interviews with startups, take some job interviews with corporates, take some job interviews with banking and consulting, and make your own decision.
Yeah, that's good advice, and it makes sense if you go corporate to think about which corporate you're working at, right? I mean, like in Hangzhou, we certainly have a whole cloud of entrepreneurs and new startups that originates from Alibaba, right? The people work there and then they strike out of their own. So I think this is a great end note for this discussion. Thanks so much for taking the time. Dinner and drinks are certainly on me next time you're in China.
Okay.
And I will add the information about your books in the end notes or the notes here. I'll check up so I have both the Chinese and English versions for those books that I have both versions. I will also put out a link to Wall Street and Gordon Ghetto. Our students are slightly younger than us, so they may not have actually seen that movie, but it's
a good movie.
Dusting it off. It is a good movie. Much better than the sequel, I would say. But this has been great. Andrew, thanks so much. And
okay,
I hope to see you soon.
Thank you. Look forward to when we can all get back to China. Okay, bye for now.
Yeah, thanks.